Right, a lot of words. Let me sort of summarise it. Basically, we see the world economy around about 3.25% this year. Long run average is 4%. So it's mistiming, it depends where you are. On this slide, I'm talking about the three economies that sort of matter for us. The US, China, and India are important. The story in the US is basically pretty good. They're starting to improve. They had a lot of weather issues at the beginning of the year. Their unemployment rates are down to 5.3. The domestic part of the economy is going pretty well, and they're very close to increasing rates. So then finally at the stage, now the market's got a 50-50 chance that they go in September. And most of the sort of rhetoric out there now is you need data to stop them from going. Now, whether they go in September or whether they go in December sort of doesn't matter. The short answer is they're about to go. And what that means is you're probably also going to see signs that the US dollar is going to appreciate. So in layman's terms, it means the Australian dollar is going to probably go further down. But the US is good in terms of fundamentals. China, I used to always say that the Chinese don't make up their GDP numbers, but unfortunately I think I'm increasingly coming to the view that they are making them up at present. What we're seeing at present is quite a slowdown in the domestic part of the economy. So if you look at industrial production, if you look at fixed investment, if you look at exports, you basically see quite a weak economy. What they're trying to do is they're trying to move over into a service sector economy. So what you've got from an Australian point of view is you've got a big slowdown in housing, you've got a big slowdown in the manufacturing sector, and in a very simple sense, the Chinese are now using less steel than they did 12 months ago, which basically means you don't need as much iron ore at a time when the big global iron ore producers are ramping up production. So fundamentally that means that the iron ore price is going to stay low, which is a big issue for Australia. Am I worried about China? Bottom line is probably not. Why not? Because they've got a lot of ability to do things to basically stimulate their economy. You may have seen in the papers that yesterday they surprised the market by depreciating the currency by 2%. They've also essentially cut rates twice. They've lowered the reserve ratio, which means they've added about 10% of additional credit. They've got a lot of extra scope to move. Their cash rates are essentially 4.85. So from my sort of point of view, I'm looking at China and saying, from an Australian point of view, it ain't great in terms of the amount of dollars we're going to get out of our iron ore and out of our other exports, but it's not about to fall over anytime soon. The other issue is India, which is starting to look better. In terms of some of the other economies around the world, it is really mixed. Europe is looking a little bit better, but it's coming from a really low base. You don't really get a lot of confidence when you realise the central bank is just about to do. We just started doing 1.5 trillion euros worth of printing money. Okay. The other thing, Greece was never really going to be a big issue unless you had essentially a flow-on effect. The very simple way to think about Greece is it's smaller as an economy than Queensland. All right? So it's a small economy that had potential, but it really doesn't have that potential anymore, because a couple of years ago, the European banks had about $250 billion of Greek bonds. Today they have less than 20. The people who own the Greek bonds basically are governments, ECB, European Central Bank, the European Commission and the IMF. So the flow-through effect is not a big issue. Japan's not doing great. Trade is really low, and so that means the Asian tigers aren't good, and Latin America is pretty bad. So you add up the world, you get a story, a lot of numbers, but basically you get a story of about 3.25. Where we're different to everybody else, or particularly to the IMF, etc., is the assumption is the economy next year is going to jump back up to 3.8. We're worried. We don't think that's happening. And this is just a chart that basically trying to find a leading indicator. You've probably heard the share market sort of is a great leading indicator. Well, actually it's not. What we're trying to do is get some sort of feel. What's in this? Well, the main things that sort of are in it are the amount of global shipping that's going around, the amount of air freight that's going around, and then we've got a couple of other things. All I want you to see about that chart is we don't see any sign of a kick at all yet in the global economy. And if you're talking about the world economy improving really quickly, it should be starting to show signs now that it's turning, and it's not. And if anything, you're getting weakness in China, you're getting weakness in some of the, essentially the developing economies in South America, etc. So our sort of story about the world is we're not really worried about it, but it's really difficult. The commodity prices, to give you a feel, because of iron ore, what's really happened in a very simple sense is the price has gone way down and the volume has gone way up. So from GDP, you count the number of tonnes. But in terms of the income coming into the Australian economy, what's happened over the last 12 months has basically taken about $50 billion of income out of the Australian economy. So you have this, GDP is really the wrong message.